The Silicon Valley Bank saga, all you need to know. In the last several days, the United States was hit by the second largest bank failure in its history, as the Silicon Valley Bank, the 16th largest bank in America, came to a crashing halt. This is called widespread panic amongst investors and customers alike, kickstarting a domino effect that's beginning to take over banks and institutions in the banking industry. And while the government has quickly intervened, some damage has already been done, and things are definitely not looking good. What measures have been taken so far? How does this affect the future? Are we all going to lose our money? We'll keep watching to find out. But before we get into it, here's a little backstory. The Silicon Valley Bank was founded in 1983 in, you guessed it, Silicon Valley. It was a brilliant idea to start a bank like that in Silicon Valley because there were tons of promising startups that needed funding, and the Silicon Valley Bank provided this funding. They worked closely with venture capital firms and private investors, acting as a channel for money to flow to these startups. They also provided banking service for larger corporations. So basically, they were raking in the big bucks. Well, actually, they were raking in the mega bucks. By 2022, the bank recorded over $171 billion in revenue and held assets worth over $200 billion. It also rolled in $7.4 billion in revenue, which is a whopping 22.8% increase in 2021. Things were definitely looking up for the bank, but then it all came crashing down thanks to one man and his terrible advice. Here's how it all happened. Banks make money from their customers in several ways, including fees on transactions and interest from the loans that they give out. Banks also invest a portion of the total deposits in long-term, low-risk investments like bonds, real estate, or stocks. Although the investments are long-term, the bank doesn't invest all of its total deposits. That way, it still has cash on reserve to serve the customers adequately. Now, this is where things start to go south for Silicon Valley Bank. Earlier this year, the federal government increased interest rates to help combat the raging inflation and protect the economy. While this essentially was a measure taken in the right direction, it didn't really do any favor to the Silicon Valley Bank. That's because the bank has billions of dollars locked up in the treasuries and the other government bonds. And the high inflation rate meant that it wouldn't make as much money as they would have. In addition, the bank's CEO and CFO had been a little greedy and invested a huge chunk, larger than normal, to make more profit. This meant that their percentage loss was going to be higher. Obviously, the public caught wind of this entire situation, and that's when all hell broke loose. Usually bank deposits are insured up to $250,000, but this was Silicon Valley, and 90% of the companies had millions with the bank. To avoid losing their money, customers started withdrawing their funds to move to a more stable bank that wasn't battling huge losses like the Silicon Valley Bank. It was reported that customers withdrew up to $42 billion in a single day, leaving the bank with negative $1 billion in balance. Thus, the bank was forced to sell off its immature investments at a lesser rate to provide cash for the panicking customers, further causing a loss of nearly $2 billion. The panic also affected smaller banks, as customers were moving their money to bigger banks just to be safe, causing them to shut down. So far, 2 banks have failed thanks to the massive bank run. In a bid to get the situation under control and prevent further damage, the federal government, through the FDIC, stepped in and shut the bank down. I know you're wondering, is my money safe? Well, yes, if you have more than $250,000 in any of the affected banks, your money is still safe, as the government has stated that all their depositors in the affected banks will be made whole, and it's not from the taxpayers' money. Payment will be made with the fund that the banks already paid into. However, the people protected are just the depositors, not the management or the investors who have stocks in the bank. Moving forward, drastic steps will be taken to ensure that this doesn't happen again. Bank regulations are about to get a whole lot stricter, and startups are going to be bearing the brunt of it. There's a lot more to come, so make sure you are subscribed to the channel, sit tight, and we'll keep you in the loop every step of the way. Until next time, ciao for now.